Oil prices are surging, the Federal Reserve is split, and megacap technology earnings are poised to move enormous amounts of equity value. This is vTalkInsight, Equity Pulse Daily for April 30th, 2026. Let us start with how the new Fed backdrop is reshaping equity risk. The latest Federal Reserve decision leaves policy rates unchanged, but the tone has clearly hardened around inflation. Persistent price pressure, driven in part by higher global energy costs and Middle East tensions, is now front and center in the Fed narrative. That combination reinforces a higher-for-longer interest rate backdrop for equities. The striking feature this time is the level of internal division, with 4 committee members dissenting, the most in decades. That tells equity markets there is no settled consensus on the path ahead, even though nobody is actively pushing for an immediate hike. The Fed collectively describes policy as roughly in the right place, but the debate about the next move is intense. In rate markets, expectations for near-term policy easing have largely evaporated. Pricing for cuts this year, and even through parts of 2026, has been stripped out as investors respond to persistent inflation data and the energy shock. Front-end Treasury yields have jumped around 10 basis points and are retesting recent highs, while long-dated yields are pushing back toward the top of the yearly range. Policymakers are signaling a high bar in both directions. They are reluctant to pivot toward an explicit easing bias while core inflation sits around 3.2% and is drifting the wrong way. At the same time, they are not eager to restart hikes unless oil-driven headline pressure feeds more clearly into underlying prices or the inflation outlook reaccelerates. Offsetting the inflation concern is a run of solid growth indicators. The wider U.S. trade deficit is being driven by a 3.3% gain in imports, and durable goods orders are rising, with core capital goods up more than 3%. Strength in computers and electronics, much of it linked to AI data center investment, underlines that business spending is still providing a meaningful cushion. Layered on top is a shift in leadership risk. Jerome Powell may be presiding over his final meeting as chair, and political scrutiny of the Fed is unusually intense. Markets currently view potential successors, including Kevin Warsh, as broadly consistent on inflation credibility, but any change at the top raises questions about how the reaction function might evolve. For equities, this mix means discount rates are unlikely to fall quickly, while the distribution of potential policy outcomes has widened. Equity and credit markets remain elevated even as yields grind higher, which increases the sensitivity of long-duration and highly valued segments to any incremental hawkish surprise. The key watch points now are subtle changes in Fed language around inflation versus growth, and whether the next few data prints justify the market's higher-for-longer stance. The macro backdrop is being complicated further by a powerful energy shock. Brent crude has rallied for 8 straight sessions, rising close to 30% and trading in the $115 to $120 range. Shipping disruptions around the Strait of Hormuz and higher insurance costs are feeding expectations that elevated prices may persist into year-end. For now, some analysts argue prices are not yet high enough to trigger outright demand destruction or materially change global growth forecasts. However, gasoline and electricity bills are increasingly acting like a tax on households and businesses. The concern is that headline inflation from oil eventually bleeds into core measures, which would likely push the Fed toward a more hawkish stance than markets currently assume. Sector impacts are uneven. Energy producers have seen support when geopolitical headlines flare, but in some cases equity markets are not aggressively bidding up major oil names, suggesting a belief that parts of the price spike are temporary and logistics-driven. By contrast, fuel-intensive sectors such as airlines and travel are already feeling the pinch, with companies like Booking Holdings citing Middle East tensions as a headwind to demand. This leaves equities facing a familiar stagflation tail risk. Persistently high input costs, even without a recession, can squeeze margins and disposable income over time. The critical questions from here are whether oil stabilizes, whether supply routes normalize, and how much of this shock gets embedded into wage and price expectations across the broader economy. Valuation is where the macro and micro stories intersect most clearly. Current S&P 500 pricing implies roughly 12% compound annual earnings growth over the next 5 years, which is demanding in any environment, let alone one with higher discount rates and an energy shock. That high bar leaves the index more vulnerable to even modest earnings disappointments. Market leadership remains narrow and heavily skewed toward technology and AI-linked names. Recent gains have been concentrated in megacaps and semiconductors, with feedback loops from passive flows and momentum reinforcing the move. Several observers now compare the pattern to past bubble episodes, warning that concentrated optimism could unwind sharply if sentiment or fundamentals slip. Outside the U.S. megacap complex, the picture is more mixed and, in some cases, more constructive. Asia and emerging market equities have actually outperformed the S&P 500 year-to-date, helped by more reasonable starting valuations. In Europe, banks are leading while technology has lagged, illustrating how sector and regional allocation are driving a wide dispersion of outcomes. Within the most crowded trade, there are pockets of relative improvement. Semiconductor earnings have grown faster than share prices over recent months, compressing forward price-to-earnings multiples even as demand linked to AI and auto strengthens. Still, with the recent equity rebound narrowly led by tech and chips, the broader index remains fragile if leadership stumbles or if volatility spikes from current, relatively contained levels. The immediate equity narrative is being driven by a cluster of megacap technology earnings. Alphabet, Microsoft, Amazon, and Meta together account for around 15% of the S&P 500 and a similar share of its profits. Options markets are pricing in very large one-day swings in the combined value of these names, underscoring how pivotal this earnings window is for overall risk sentiment. So far, the operational data from the hyperscale cloud businesses point to robust demand. Microsoft's Azure posted revenue growth close to 40%, slightly ahead of already high expectations, while Alphabet's cloud division delivered growth above 60% and surprised to the upside. That acceleration reflects strong enterprise adoption of AI workloads and confirms that cloud infrastructure remains a key beneficiary of the AI build-out. Yet share price reactions show just how demanding the market's bar has become. Microsoft stock traded lower after hours despite the beat, as investors question the sustainability of AI-driven revenue and the pace of broader adoption. Meta declined as well, with a planned $10 billion step-up in AI-related capital expenditure and ongoing regulatory risks raising fresh concerns about the near-term payoff from heavy spending. Alphabet has been a notable bright spot. Management highlighted more than 500 million downloads of its AI models and a 30% reduction in the cost of AI responses, suggesting both rapid adoption and improving unit economics. Together with strong cloud performance and in-house chip development, that positions Alphabet to compete more directly with semiconductor leaders in certain AI workloads. Attention now turns to Amazon, where Amazon Web Services is expected to show revenue growth in the high 20s to low 30s% range, up from the mid-20s previously. Markets are especially sensitive to whether AWS growth pushes above 30% and whether management raises full-year or even 2026 capital expenditure guidance. The pattern across Alphabet, Meta, and Amazon suggests investors will only tolerate larger AI budgets if they are clearly matched by faster top-line acceleration. Beneath the platform layer, the AI infrastructure cycle remains powerful. Companies like Anthropic and OpenAI are estimated to be running at roughly a $50 billion annualized revenue pace from almost nothing 2 years ago, highlighting the speed of monetization. That is feeding directly into demand for chips and storage from suppliers such as NVIDIA, Broadcom, and Seagate, all of which are signaling structurally stronger outlooks tied to cloud and AI capex. There are also signs that semiconductor demand is broadening beyond data centers. Multiple chipmakers, including Texas Instruments and ST Microelectronics, report improving orders from the automotive sector, with at least one major producer seeing its share price surge on better auto demand. The combination of AI infrastructure investment An emerging auto semiconductor recovery and more reasonable valuations keeps the chip complex central to the equity story, but also heightens the impact any disappointment could have on the wider market. Beyond technology, financials and consumer names are providing important signals about the underlying economy. European banks have delivered a run of strong results, with UBS reporting quarterly profit above $3 billion and investment banking revenue up nearly 30%. Lloyds and Santander also beat expectations, helped by healthy net interest income and, in Santander's case, a sizable capital gain from a Polish business sale. UBS shares jumped almost 5% on the profit beat and an enlarged share buyback program, underscoring management's confidence in capital generation. However, the bank faces a potential headwind from proposed Swiss rules that could require 100% capital backing for foreign subsidiaries, which might constrain future lending, acquisitions, or payouts. Management expects the legislative process to be slow, leaving a period of uncertainty that equity investors will need to monitor. On the consumer side, Starbucks delivered its first earnings beat in 5 quarters, with U.S. same-store sales up just over 7%, driven primarily by higher transaction volumes rather than price increases. Operational improvements and cost savings of more than $2 billion are feeding through to margins, even though management guides to some moderation later in the year. In contrast, the travel and airline complex looks more strained. Booking Holdings has cut its outlook on weaker Middle East travel demand. Avis is under pressure after a wider loss and a fading short squeeze, and Spirit Airlines faces acute financial stress from engine issues, failed consolidation plans, and higher fuel costs, prompting debate about its long-term viability. Pulling this together, equities are trying to balance a higher-for-longer rate regime, an evolving energy shock, and an AI-driven earnings engine that still looks powerful but increasingly valuation-constrained. The Fed has paused while signaling deep internal division and limited appetite for near-term cuts, just as oil, shipping costs, and geopolitical risk raise the chance that inflation stays sticky. At the same time, megacap technology, cloud, and semiconductor companies are reporting strong operational numbers, yet face a market that is quick to punish any hint that AI spending is running ahead of revenue. Thanks. Selected consumer franchises and parts of autos are demonstrating resilience, while travel and airlines show how quickly higher energy costs and regional conflicts can hit demand. From here, the key signals to watch are incremental changes in Fed communication, the trajectory of oil and shipping risk premia, the next leg of capex and growth guidance from Alphabet, Microsoft, Amazon, and Meta, and whether equity leadership broadens beyond a narrow group of AI beneficiaries. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.